Welcome back to the deep dive. Today is Wednesday, February 18th, 2026. And, I was looking at the terminal this morning, and I have to be honest, I got this distinct feeling of, I don't know, vertigo.
Vertigo. That is a
Ah.
very, very good word for it.
Yeah, that sensation when you're standing on a platform and a high-speed train just screams past you, and for a split second, the air pressure it changes and you feel like you might get sucked in.
Oh, yeah?
That is what the global news cycle feels like right now.
That is a very vivid and, frankly, a very accurate description. We're sitting at a convergence point, a real one.
It feels like it.
It's rare that you see the tectonic plates of European finance, Asian geopolitics, and Silicon Valley hardware all shifting violently on the exact same morning.
Right.
Usually we get a crisis in one sector while the others are sort of sleeping. Today, nobody is sleeping.
But it feels uncoordinated, though. That's the strange thing. On one hand, you have this massive, almost retro-industrial push, building plants, digging mines, merging these ancient banks. And then on the other hand, you have AI models updating themselves every 12 days and rumors of personal superintelligence.
Right.
It feels like we're trying to build a steam engine and a warp drive at the same time.
It might feel uncoordinated, but there is actually a very strict, albeit incredibly expensive logic to all of it.
Okay.
If you look closely at the stack of reports we have today, from the bank mergers in Milan to the chip fabs in Georgia, there is a single golden thread connecting all of them. The digital world has finally realized it cannot exist without the physical world. It just can't.
This is the halo concept I've been seeing in the research notes, isn't it?
Exactly. HALO, heavy asset, low obsolescence.
Right.
It's the new buzzword on Wall Street, sure, but it's more than just marketing. It's an admission that the last 20 years of move fast and break things in software, that's over. Now, if you want to move fast, you have to build things, heavy things, expensive things. And that realization is reshaping everything from Italian banking to Japanese foreign policy.
Well, we have a lot to get through, a massive stack. We need to talk about the end of an era in Italy, the rumors swirling around Christine Lagarde at the ECB.
Which is some serious political drama.
Oh, absolutely. And then the absolute absurdity of the money being spent in Silicon Valley right now. I mean, the CapEx numbers we're seeing are bigger than the GDP of most nations.
It's an arms race, quite literally. It's the only way to describe it.
But we also have to talk about the countermove, the great contrarian.
Yes.
While everyone is zigzagging into tech, Warren Buffett is zagging back to, well, ink and paper.
Which is my favorite story of the week, hands down.
Mine too. But let's not get ahead of ourselves. We have to start in Europe,
Right on.
specifically Italy, because while Silicon Valley is obsessed with the future, Italy just closed the book on a very, very long chapter of its past. Yesterday evening, the board of Monte dei Paschi di Siena MPS approved the full integration of Mediobanca.
This is significant. It's a huge deal. If you are not a student of European financial history, the name Mediobanca might just sound like another bank.
Just another name, yeah.
But this isn't just a bank merger. This is the dismantling of what was known as the Salato Buono, the good drawing room of Italian capitalism.
Mediobanca was the puppet master, right? For decades, that was its reputation.
Puppet master is one way to put it. Under Enrico Cuccia, Mediobanca was the nexus. It was. It was the central hub.
The room where it happened?
The room where it happened for Italy, absolutely.
Right.
It was where the industrial families, the Agnellis of Fiat, the Pirellis, met to decide the fate of the Italian economy. It was a publicly traded entity, yes, but it operated like a private club.
And yesterday.
And yesterday, the board of MPS decided to swallow it whole.
And not just swallow it, but hide it. The report says they are delisting it.
That's the headline that really matters here. Piazzetta Cuccia, the colloquial name for the institution, named after its historic Milan address, is leaving the public market.
Wow.
The ticker symbol MB, which has been a fixture on the Piazza Affari, the Milan Stock Exchange, is gone.
And for how long was it there?
Get this. It would have been the 70th anniversary of its IPO on March 21st.
So instead of a platinum jubilee, they get a funeral.
They get absorbed. That's a good way to put it.
Yeah.
The new entity will be a private company, Mediobanca SpA, 100% owned by MPS.
I have to pause here because there's a rich irony in this.
There is.
MPS Monte dei Paschi is the oldest bank in the world, literally founded in 1472. But for the last 15 years, it has been the sick man of Europe.
The basket case, absolutely.
It's needed bailouts, it's had scandals, it's been a total mess. And now that bank is eating the prestigious, powerful Mediobanca.
It is deeply ironic, but is also highly strategic. MPS is essentially stripping Mediobanca down to its most profitable engines,
The good parts.
the really good parts: corporate investment banking, or CIB, and high-end private banking. They're turning it into a specialized, very focused division. But, and this is crucial, the real story isn't the banking operations.
It's never the stated reason, is it?
It's about the jewel. That's what the analysts are calling it.
The stake in Generali.
Correct. The 13.2% stake in Generali, which is one of the largest and most powerful insurance companies in the entire world.
Right.
In the complex web of Italian corporate power, holding that stake gave Mediobanca immense influence over the insurer.
And insurance companies are basically just giant piles of capital looking for places to go. So if you control the insurer, you control the capital flow.
Precisely. You've hit the nail on the head. With this merger, that 13.2% stake effectively passes to the control of the Caltagirone Group, who are the major shareholders in MPS.
Ah, okay. So it's a power shift.
It's a massive power shift. The analysts are saying the line passes to Caltagirone. It shifts the center of gravity in Italian finance away from the old Mediobanca management and toward a completely different set of industrial interests.
So if I'm an investor looking at this, is it a done deal? Is the Mediobanca we knew just gone?
The corporate structure as a public entity, yes, that's gone. The brand will remain as a symbol of excellence, according to the press release, but it will be an internal brand. It's a name on a division.
And what's next? What's the market waiting for?
The market is now looking to February 27th. That is Investor Day for MPS. That is when they will reveal the full industrial plan. They're promising $700 million in synergies.
Synergies usually means layoffs and cost cutting.
Usually.
Yeah.
And there will certainly be some of that. But in this case, it might also mean leveraging that very powerful private banking arm to cross-sell to MPS's massive retail base.
So trying to actually grow the business.
It's a classic consolidation play at the end of the day. You're taking a heavy asset, a historic bank, and removing the obsolescence of its old governance structure and public market pressures.
Okay. While Italy is cleaning house, there's another drama unfolding a bit further north.
Much more political one.
Yes. The Financial Times dropped a bomb regarding the European Central Bank. And this one feels less like a business deal and more like House of Cards.
It does have a cinematic quality to it, doesn't it? The FT is reporting pretty solid rumors that Christine Lagarde might exit the ECB presidency early.
Okay, her term runs until October 2027. We are in early 2026. That's a long way out. Why leave now? The Eurozone seems relatively stable. Inflation is coming down. Why would you rock the boat?
Because the boat is heading toward an iceberg called the French presidential election.
Ah.
That's in April.
So this is about Macron. This is French politics spilling over into monetary policy.
It's about the fear of what comes after Macron. The current political establishment in Europe, essentially the alliance between President Macron in France and Chancellor Merz in Germany, is, to put it mildly, terrified of the extreme right.
Okay.
They are looking at the polls, they see Marine Le Pen or Jordan Bardella gaining ground, and they are doing the math.
And the math says what?
The math says that if the French presidency flips to the hard right in April, and Lagarde leaves on schedule in October 2027.
Then the new French president would have a huge say in who replaces her.
A veto, essentially. Exactly. And a Eurosceptic French president could demand a central banker who is hostile to the current consensus, or at least very, very different from the technocrats we're used to.
So the move is to get her out now.
The rumor, the strategy, is that Lagarde steps down now, allowing Macron and Merz to pick a successor while they still have the political capital to force it through.
That is incredibly cynical. Smart, but cynical. Let's rig the appointment before the voters get a chance to change the government.
It's pure realpolitik. Now, for the record, the ECB has come out and flatly denied this. The spokesperson said Lagarde is focused on her mission and has made no decision to leave.
Of course they did.
But, in these circles, a denial is often just a placeholder until the deal is cut behind closed doors.
So if she does go, who are the replacements? Are we talking about another politician or a pure central banker?
The names circulating are heavyweights, real technocrats. You have Joachim Nagel, the head of the Bundesbank.
The German. Hawk.
Very much a hard money guy, yes. Then you have Luis de Cos, who has navigated the Spanish and Greek complexities very well. He's seen as more pragmatic.
Okay.
And you have Klaus Knot from the Netherlands, who is sort of a middle ground candidate.
If Nagel gets it, that signals a very strict, disciplined, almost German-style ECB. If de Cos gets it, maybe a bit more flexibility for the southern states.
That's the read, potentially. But regardless of who it is, the goal is continuity. They want to lock in the system before the populace can touch the controls.
What's surprising to me, though, is that despite all this political maneuvering and instability, the European markets seem fine. Actually, better than fine.
That is the big surprise. It's the no landing consensus we're seeing.
Right.
There was so much fear of a recession, a hard landing. Then everyone got their hopes up for a soft landing. Now, 74% of European fund managers are saying, what landing? They just see growth continuing.
Driven by what?
Infrastructure, especially in Germany. They see a massive rebuild cycle starting.
And they're putting their money where their mouth is.
They really are. 85% of managers see Europe outperforming the U.S. in the near term.
85%. That's a massive consensus.
It is. That is a huge rotation in sentiment. And look at the sectors they're overweight. Healthcare and banks.
Well, banks make sense if we're seeing mergers like Mediobanca. It implies the sector is getting more efficient, more profitable.
And it implies that the heavy assets of Europe, the infrastructure, the banks, the health systems, are finally being valued over the frothy growth stories of the past. It feels like Europe is suddenly looking like the adult in the room compared to the volatility in the U.S.
Speaking of the U.S. and volatility, let's pivot to the geopolitical stage. Because you really can't talk about 2026 without talking about the Trump presidency and the new alliances that are being formed.
Absolutely. And we have a major development with Japan this week. President Trump has announced a framework that involves, well, a lot of money. $550 billion in investment.
Oh, $1 trillion. That's a staggering number. Is this real money or is this just a press release promise?
It's a bit of both, but the immediate cash is very real. They announced a first tranche of $36 billion.
Okay.
And if you look at where that money is going, it tells you everything you need to know about the current administration's priorities. It's not going to Silicon Valley.
Where's it going?
It's going to Texas, Ohio, and Georgia.
Swing states, or at least politically vital states.
And look at what they are building. An LNG plant in Texas, a natural gas power plant in Ohio, a critical minerals processing plant in Georgia.
This is the definition of halo.
It's the poster child for it. Heavy assets,
Yeah.
energy, minerals, manufacturing, physical stuff.
So this is Japan saying, we understand the assignment. They aren't trying to sell software to the U.S. They are physically embedding themselves into the U.S. industrial base.
It is a massive insurance policy for Japan. They know that trade barriers are going up. They know the U.S. is becoming more isolationist, more America first.
Right.
So how do you ensure you don't get locked out? You build the factory inside the fortress. You become a domestic producer.
The trade data backs this up, right? You mentioned earlier that Japanese exports are up overall, but not to the U.S.
It's a fascinating divergence. Japanese exports overall surged 17% in January, meeting all expectations.
Okay.
Exports to the rest of Asia were up to 26%. Exports to Europe up 25%. Huge numbers. But exports to the U.S. actually dipped by 5%.
So they are selling less stuff to America from Japan, but investing more capital into America to build stuff.
Exactly. They're localizing production in the U.S. to avoid tariffs and political headaches while pivoting their export economy to the rest of Asia and a recovering Europe. It's a very sophisticated hedging strategy.
But Japan has its own serious problems at home. We can't ignore the IMF reports that came out. It feels like every time Japan tries to spend money, the IMF shows up like a grumpy accountant and says no.
The IMF is genuinely worried, and for good reason. Premier Takaichi has been pushing a very populist, expansionary agenda. Her flagship policy is keeping the VAT on food frozen at 8%.
Which is great for regular people. I mean, food is expensive.
It is extremely popular, but the IMF argues it destroys the fiscal cushion.
The what?
The fiscal cushion. The ability to raise taxes or cut spending when a real crisis hits. Japan has the highest debt-to-GDP ratio in the entire developed world. It's not even close.
And the IMF is saying you need to collect taxes now.
Because you are going to need that money when the next shock hits, whether it's an earthquake or a financial crisis.
And the cost of that debt is rising. I saw a projection about interest payments that it made my eyes water.
It is the debt bomb ticking in the background of everything they do. Interest payments on Japanese government debt are projected to double by 2031.
Double to what?
We are looking at nearly $141 billion per year.
$141 billion just to pay the interest.
Just to pay the interest on past borrowing. Not for new schools or roads or defense. It's just servicing the debt.
That's more than the entire military budget of most countries.
It's a staggering figure. And that is the trap they're in. If global interest rates stay even moderately high, Japan is in a vice. So Premier Takaichi is trying to stimulate growth with tax cuts, while the debt servicing costs are eating the budget alive. It's a race against time.
And then meanwhile, you have Japan's neighbor or rival, depending on how you look at it, India, and they're taking a completely different path.
A very different path.
They aren't focusing on LNG plants in Ohio. They're going all in on the digital future.
Prime Minister Modi has clearly decided that India missed the manufacturing boat compared to China, so they are going to leapfrog directly to the AI boat. He wants India to be the global hub for AI and data centers.
And the number there is, what, $300 billion?
$300 billion in public and private investment. It's a huge national project. And who is right there in the middle of it?
Let me guess, NVIDIA.
Always NVIDIA.
They're everywhere.
NVIDIA is partnering with private equity firms in India to fund startups, build out data centers, and essentially architect the sovereign AI infrastructure of the entire country.
It's a smart play for NVIDIA. If you get a country of 1.4 billion people hooked on your hardware,
You win the century. It's that simple.
this brings us neatly to the main event. We've danced around it with the Japanese power plants and the Italian banks, but we need to talk about the tech deep dive. This is where the halo concept really originates.
It is. JP Morgan was one of the first to identify this rotation. For 20 years, the market absolutely loved asset light.
Right.
Think of Uber. They don't own the cars. Think of Airbnb. They don't own the hotels. Think of Facebook. They don't create the content.
Yeah.
It was all about software scaling infinitely with zero marginal cost.
Which was a brilliant business model. High margins, low physical risk.
But the AI revolution has completely flipped the script.
Yeah.
You cannot have virtual intelligence without massive, and I mean massive, physical power.
Okay.
AI models are hungry. They eat electricity like nothing we've ever built before. They live in these enormous concrete buildings filled with copper wiring and cooling water. They run on silicon that has to be manufactured in billion-dollar fabs.
So the heavy asset is the prerequisite for the virtual product.
It's the foundation, correct.
Right.
And the companies realizing this are now spending money at a rate that is frankly hard to comprehend. We call it the CapEx explosion.
Let's look at Meta. Mark Zuckerberg. I remember just a few years ago, everyone was laughing at his metaverse spending.
Now he is doubling down, but on AI infrastructure, Meta's CapEx, their capital expenditure, is projected to hit $135 billion this year.
$135 billion. I want to contextualize that. That is roughly the GDP of Morocco.
It is.
One company spending an entire nation's economic output on how? What are they actually buying for that much money?
They are buying the future of compute. That's the only way to describe it. They are buying data centers. They are buying custom silicon. They're designing themselves, and they are buying millions of NVIDIA processors.
Millions.
That's the guidance. Millions of GPUs. And we aren't talking about the graphics cards you put in your gaming PC. We are talking about the brand new Blackwell architecture.
Let's get technical for a second. Why does Blackwell matter? Why is everyone, not just Meta, scrambling for these specific chips?
Blackwell is a beast.
Yeah.
It's actually two huge GPU dies that are connected so seamlessly that the computer sees them as one giant chip. It offers just massive throughput for training AI models. But more importantly, Meta is looking beyond that to the Vera Rubin platform and, critically, the new Grace CPUs.
Grace. I've heard this name. What's the significance?
The Grace CPU is critical because in traditional computing, the CPU, the main processor, can be a bottleneck. It can't feed data to the super-fast GPU quickly enough. It's like trying to fill a fire hose with a garden hose.
And Grace fixes that.
NVIDIA built Grace specifically to unclog that pipe. It's designed to work in perfect harmony with the GPU, allowing massive amounts of data to flow into it instantly. When you are training a model with trillions of parameters, that data flow is everything.
So Zuckerberg is building a machine that has no bottlenecks. A perfect computer.
He wants to build a planetary scale computer. His stated vision is personal superintelligence. He wants an AI agent for every single person on Earth. To do that, you need infrastructure that doesn't exist yet. Hence, the $135 billion check.
And it's not just the hardware that's moving at this insane pace. The software, the models themselves, are iterating at a speed that feels almost unsafe.
It's breathtaking. We just saw Anthropic release Claude Sonnet 4.6.
Right, and what's wild is the timeline. They released Opus 4.6, their flagship, supposedly smarter model, just 12 days prior.
12 days.
12 days. Usually you have a year between major software releases. Maybe 6 months if you're really pushing it.
That cycle is collapsing into days.
Yeah.
And here is the scary part, or the exciting part, depending on your perspective. Sonnet 4.6, which is supposed to be the lighter, faster model, is already beating the previous Opus model in key areas like coding and complex operations.
So the cheap model is now smarter than the smart model from 2 weeks ago.
Yes.
That creates a massive paradox for businesses, doesn't it? If I spend millions integrating the Opus API today, and 2 weeks later a cheaper, better version comes out, my entire investment is obsolete instantly.
That is the low obsolescence part of Halo.
Right.
The software becomes obsolete instantly. The code is ephemeral, but the infrastructure, the data center, the power plant, the copper wire, that value holds. That's why the smart money is moving to the physical layer. The code changes every week, but the need for electricity to run the code never goes away.
Speaking of companies that usually try to avoid this kind of chaotic spending, Apple, they have an event coming up on March 4th, and they're doing something weird with it.
Very weird for Apple. They are holding the launch event simultaneously in 3 cities: Cupertino, New York, and Shanghai.
3 cities, 3 time zones. Why? What does that signal?
It signals a physical product, a major one, something that needs to be seen and touched globally by press in all the key markets at the same time. You don't do a massive 3-city logistics operation for an iOS update,
The rumors are pointing to a low-cost MacBook.
a $700 to $900 entry point. This is Apple directly attacking the Chromebook market.
In schools and enterprise.
Exactly. They realize that if an entire generation grows up using Google's OS, they lose the future. They have to compete on price in that segment.
But there's a wilder rumor, something much more sci-fi. The pendant.
The ambient computing device.
Yeah.
This is the really interesting one.
I have to admit, this concept creeps me out a little. A device with no screen that you wear on your clothes. What is that?
Think of it as the anti-Vision Pro. The Vision Pro surrounds you with screens. It's an immersive experience. The pendant aims to remove the screen entirely.
How does it work?
It listens to your conversations, it sees what you see via a tiny camera, and it whispers assistance into your ear through your AirPods.
So I'm walking around and meet someone, and the AI whispers in my ear, "That's Bob from accounting. You met him 3 years ago at the holiday party. Ask him about his daughter, Sarah."
Exactly that. Or you look at a menu in a foreign language, and it translates it audibly for you in real time. It's about making the computer invisible.
But to make the computer invisible, you need massive AI processing in the cloud.
Again, it all goes back to the data center, the ALO asset.
It feels like we are inching toward a world where we are just constantly being recorded and analyzed.
We absolutely are. Look at the smart glasses market. Luxottica and Meta are deepening their partnership. Luxottica's CFO came out and said they want to flood the market with their Ray-Ban smart glasses.
What are the projections on that?
They're projecting 100% annual growth, doubling every single year. They expect to reach 110 million units sold by 2030.
110 million. So in 4 years, one in every, I don't know, 60 or 70 people on the planet will be wearing glasses that have cameras and AI built in.
And that number will just keep growing.
It fundamentally changes the social contract. If everyone has a camera, privacy as we know it is dead.
Or privacy evolves into something new. But from an investment standpoint, it's another perfect heavy asset play. Luxottica makes physical frames. They have factories, global distribution, thousands of retail stores.
And Meta needs them.
Meta provides the AI, but they desperately need Luxottica's physical dominance to get the tech onto people's faces.
It's the same theme over and over. The tech giants need the physical giants. Meta needs Luxottica. OpenAI needs the power grid.
And that brings us to the ultimate counterindicator, the Oracle of Omaha.
Warren Buffett. In the middle of this tech frenzy, he made some moves in his latest filing that confused a lot of people.
Berkshire Hathaway released its 13F filings, and the changes were notable. Buffett sold 77% of his Amazon stake.
77%. That's a huge dump.
He sold more Apple. He is methodically cashing out of the digital ecosystem.
That sounds like a massive warning bell. If the greatest investor of all time is selling tech while everyone else is buying, shouldn't we be worried?
He's certainly reducing his exposure to these very high valuations, but the fascinating part is what he bought.
Go on.
He bought 5 million shares of the New York Times.
A newspaper, a legacy ink and paper, mostly newspaper.
In 2026. Why?
Think about the Halo thesis again, but from a different angle. In a world where AI can generate infinite content for free, infinite blog posts, infinite images, infinite fake news, what becomes the scarce asset?
Verification. Human trust. A brand that has a 170-year track record of, at the very least, trying to check facts. Buffett isn't betting on the newspaper business model of the 1990s.
He's betting on something else.
He's betting that in a world of AI noise, verified reality becomes an incredibly valuable premium product.
That is a fascinating take. So while Meta spends $135 billion to create synthetic intelligence, Buffett spends a few million to buy the antidote.
It's a classic value play. Buy the thing that is undervalued but essential. If the internet becomes a sewer of AI sludge, a trusted source like the New York Times becomes a walled garden of clarity, people will pay for that.
And it connects to the media M&A mess we're watching, too. The whole Warner Bros., Paramount, Netflix saga.
Yeah.
That situation is just a disaster.
It is a complete soap opera. Warner Bros. Reopened talks with Paramount, but they only have a 7-day window.
And there are multiple bids on the table.
Paramount seems to be looking for an offer of $31 a share. The Netflix offer is reportedly $27.75.
But Netflix stock is getting hammered.
Down 40% since the rumors started. The market absolutely hates it. They think Netflix should stick to what it does best, streaming, not buy declining cable assets.
But again, isn't Paramount a heavy asset? They own studios. They own a massive library of intellectual property.
They do. They own Star Trek and SpongeBob. But the market thinks Netflix is overpaying for old media baggage. And to make it even more complicated, there's a national security angle now, concerns about foreign funds backing the Paramount bid.
Everything is geopolitical. You can't even buy SpongeBob SquarePants without the government checking your passport.
That is the world of 2026. Everything connects back to everything else.
So let's zoom out. We have a bit of time left, and I want to look at the markets. How are investors actually handling this? We have Japan borrowing heavily, tech spending heavily, and Buffett selling. It feels incredibly volatile.
The volatility is extreme, even if the indices don't show it. 30% of the companies in the S&P 500 have moved more than 20% in the last 3 months.
30% of them, that is. That's not normal. Usually the S&P is a pretty steady ship.
It's incredibly choppy beneath the surface. The indices, the S&P 500, the NASDAQ, they look calm because they are near record highs, propped up by a few mega-cap stocks.
The big guys.
But under the surface, individual stocks are getting slaughtered or rocketing to the moon. It's a stock picker's market, but it's an incredibly dangerous one.
And what about Bitcoin? Where's that in all this mess?
Surprisingly boring, which is a new feeling for Bitcoin. It's just been stable at around $67,000. It's acting more like digital gold, a store of value amidst the chaos, than a speculative tech stock right now.
And the Fed. Do they have any clue what to do with this halo inflation? Does building physical things cause a different kind of inflation than just printing money?
They are completely divided.
Yeah.
You have Governor Barr from the Fed saying, hold rates, be patient. Then you have Governor Goolsbee saying, cut, we need to provide relief.
So they don't know.
The data is contradictory. GDP is growing, but so is debt. Tech is booming, but the average consumer is getting squeezed. They are flying blind just like the rest of us.
So let's try to bring this all together for the listener. We started with this idea of halo heavy asset, low obsolescence.
Yes. The core thesis is that the purely digital world has hit a physical wall. To grow further, it needs atoms, not just bits.
It needs stuff.
It needs power plants in Ohio.
Yeah.
It needs bank branches in Milan to consolidate capital. It needs optical factories in Italy for smart glasses.
So the big rotation we're seeing is away from pure software and towards infrastructure.
Correct. If you are looking at your portfolio or just trying to understand the news, ask yourself, is this company building something real? Or are they just moving data around? The money, right now, is flowing to the builders.
But there's a massive risk there. Building things is hard, it's expensive, and things break. It's not like software.
And it takes time. A lot of time. You can write a new AI model in a few weeks. It takes 5 years to get a permit and build a new gas plant.
And that's the conflict.
That mismatch in speed is where all the tension lies. The AI wants to move at the speed of light, but the power grid moves at the speed of a county permit application.
That's the ultimate bottleneck.
That is the defining conflict of 2026, I think.
And this brings me to a thought I've been having while listening to you. We talked about Meta's AI iterating every 12 days. We talked about the human inability to keep up.
Yes.
Are we reaching a point where the limiting factor isn't the chip or the power or the money, but us, our own ability to adapt?
Go on. That's interesting.
Well, if Claude Sonnet 4.6 is better and cheaper than Opus from 2 weeks ago, that means every business workflow I designed around Opus 2 weeks ago is now inefficient. But I can't retrain my entire company every 2 weeks. Humans need stability. We need habit. We can't operate at that speed.
That is a profound point. We're building a technological engine that accelerates exponentially, while our biological and social evolution is, at best, linear. We just can't adapt that fast.
So what happens? Do we just let the AI run everything because we're too slow to keep up with it?
That is the Mark Zuckerberg vision, isn't it? The personal superintelligence that handles all the complexity for you. You don't need to learn the new software. Your AI agent learns it for you. You just
Hmm.
exist, and you ask your agent to do things.
That sounds terrifying. It sounds like the movie Wall-E. We just sit in the chair and let the machine drive us around?
Or we look at what Warren Buffett did. We consciously decide to value the things that don't change. Truth, trust, human connection, physical reality. The
Uh,
reason the physical is coming back into style isn't just because AI needs electricity, it's because humans need grounding. We can't live entirely in the cloud. We live in houses, we eat food, we need bridges to drive on.
so the revenge of the physical is actually a human-led correction. We got too lost in the digital, and now gravity is pulling us back down to Earth.
I think that's the perfect way to frame it. The pendulum swung way too far into the virtual, and for the last 2 decades, that's where all the value was. Now, with Banca, with the Japanese factories, with
Yeah.
the Buffett trade, the pendulum is swinging back to the real.
Well, I feel slightly less dizzy now. Still anxious, but at least I understand why I'm anxious.
Understanding is the first step.
Exactly. We covered a huge amount of ground today. The end of Italian financial history, the French political gambit at the ECB, the $500 billion Japanese bet on America, and the Silicon arms race. If you want to dive deeper into any of these, the source notes are available.
And keep an eye on that February 27th date for the Banca plan and March 4th for whatever Apple is about to unveil. The next few weeks are going to be critical.
We will be watching. Thanks for joining us on the deep dive. Keep your head up, stay curious, and we'll catch you in the next one.
Goodbye, everyone.